Hi everyone, I'm Peter Stanton, publisher of the Worcester Business Journal. Thanks for joining us today for this special virtual event on business exit strategies. So I'm a business owner, as are many of today's attendees, and someday the time will come for the transition of that business to a new set of hands. For most of us, that will probably be our first transaction or maybe our second, but we won't have gone through that event very often. Today, we've got a team of expert advisors who know that process through and through, and they're going to be sharing their wisdom with us, not only about best practices, but also some of the common pitfalls that business owners face when navigating an exit and how to avoid them. We've also got a conversation with a business owner who sold a good percentage of his company and has been through that process and can also share his experience. This event is coming to you live streamed, but also it's also being recorded, and a link to the full session, today's full session, will go out to all registered attendees within the next day or two. Importantly, if you have a question that comes up during these presentations, we'd like you to be able to ask that. You can enter that question into the chat or the Q&A feature on your screen, and we'll try to get to as many of those questions as we can live. And I know if we don't get to them, I think our panelists will be happy to follow up with you afterwards and make sure that those questions get answered. I want to thank our sponsors today, Bartholomew and Company, checking the screen, ROCG Consultants, and S&G Business Consultants and Certified Public Accountants. We're going to kick things off with Terry Shepherd and Ronen Shefer. Terry is the managing partner of S&G Business Consultants and Certified Public Accountants and a founding partner of ROCG Consulting, LLC. And Ronen Shefer is also a founding partner and CEO of ROCG Consulting. Terry and Ronen together wrote a book. There they are, and their picture appears. Are you guys on the back here? No, we know the photo. We've got a little highlight. The book is right here. It's called The Graduate Level of Business Ownership. And everyone who is registered today is going to be receiving a copy of that book. It's 154 pages of terrific wisdom, so that if we somehow in the system we don't have your mailing address, please make sure you fill out whatever form so that we can get a copy of that out to you in the mail. So without further ado, I'm going to hand the first conversation over to Terry Shepherd. Terry, welcome.
Thank you, Peter. And thank you all for joining us. And I would like to start this right off with getting some of your participation with a quick question. So within 10 to 15 seconds, if you can just type in, how do you define success in business? How do you define it? So I'll give you a couple more seconds in there, and we'll see if you had company revenue, the profitability, industry recognition, or the ability to sell the business. So Peter, did you see any of these come up in the on the little chat screen? And was there any others besides these four?
I think those four are represented. That's most of the definition of success that's coming through.
Okay, great, thanks. And so we're here today to tell you that it's not all about the money. You know, we've worked with and we know many business owners who are quite wealthy and are pretty miserable, right? Because they don't have things that are fulfilling. They haven't defined their value drivers, what excites them the most, of getting up in the morning. And so we think it really comes down to the business being able to provide the owner to live their dreams and to fill their goals and objectives along the way, and to get into the place where they can decide when to sell, who to sell it to, and for how much. And with that, I turn it over to Ronen.
Thanks, Terry. So one of the things we wanted to look at too is to be able to test it and look at what scenarios would you guys prefer being in as a business owner. And these are scenarios that we've seen and came across in our, 3 decades of doing this thing, Terry? One scenario is simply just grinding away. You don't really have a plan. You're grinding away in the business. One day you're going to sell it. One day you hope to sell it. And you're in the trenches. And a lot of businesses can, and business owner can certainly relate to that. The second scenario is one by which, yeah, you are a profitable business, but when you look back, you're really sacrificing a lot of time, a lot of your life in it. Go ahead, forward this, please. And it's really come down to, is it enough, for me to be able to provide for my family and really fulfill my dreams? I'm sacrificing everything that I've gotten in this business. The third scenario is I'm actually maximizing everything that I've done, but I'm really not planning for the day after the business. What's going to happen afterwards? Kind of leaving everything to chance when it comes to that. And to us, those are the people that are currently operating the business not at the graduate level. We've been using the term the graduate level business ownership for several years now in our practice, probably a couple of decades, if you think about it. And it really comes to defining it in this term. And Terry touched base on it when he talked about what's the definition of success. But it really comes down to the fourth scenario, which is I have a strategic plan, and the business now becomes the catalyst to provide the life that I want. It's not the other way around. I mean, you got to ask yourself as a business owner, does the business help your personal life or takes away from your personal life? That's really what it comes down to. Is it helping you achieve your goals, or is it taking away from things that you wanted to get done? So that's really the fourth scenario. All right, click through. Next one. In this particular virtual session, we're talking about the exit part of it, and one term I want everybody to think about, and I'll touch base on it later on in the presentation. In our view, and some of the things that we wrote in the book, the best time to sell the business is actually when you don't need to. I'll let that sink in, and we'll touch base on it a little bit, later on. But it is true. The best time to sell a business is when you don't need to, when it's not forcing you because of a death in the family or your own death, because the business is not fun anymore and you want to get rid of it, or you simply reach retirement age and it's time for me to leave. So I'll leave you with that thought, and I'll touch base on it again a little bit later on. The main purpose of the book for us, as we sat down to write it, was all the businesses that we dealt with. And Terry mentioned, there are some small, under $1 million businesses that are run very successfully, and there are some multi-million-dollar companies that are dysfunctional. So what are the traits that actually make somebody operate at what we call the graduate level of business ownership? So throughout the book, we talked about a lot of different things, and we bring a lot of stories to it, but there are probably 8 traits that we want to talk to you today. And then I'll let Terry start with that, and I'll jump in and talk a little more later.
Right. Thanks, Ronen. So trait number 1, the planning when you're first starting is not limited to just the business. We start with the personal objectives, and when you're first starting a business up, there's a time when you just put your head down and keep on going forward because you need to put groceries on the on the kitchen table, and you're consumed by the business. But there comes a time in both the owner's life and the business's life cycle that the owners need to step back and be able to start taking control of the business. And you do that by defining what your value drivers are and what the personal goals and objectives are, both financial and non-financial. And we should be using those going forward. As Ronen had mentioned, that should be the driving force of any strategic planning going forward. And once you understand the value drivers of what brings you the most excitement and most fulfillment on a regular basis, when we've worked with owners, when they start going astray or thinking about because they have an offer coming through, even though we've already discussed that, and that's not really where they want to be long term because they have this set plan that involves their family, the management team, etc. We're able to, and other advisors would be able to, reel them back in to be able to get back to those value drivers and keep them on the course of what they first stated, to make sure they're following through with that strategic plan, because all these plans should be having milestone dates. So we've asked these questions in this personal planning session. It's really a what's it all about Alfie questions of getting into what's really important in life and not becoming so of building value, but what it's all about, and is my life kind of worth what's been going on? So we ask people to dare to dream. You know, if they're not doing it now, when they're going to do it? Because so often they keep on putting things off. We're going to wait until the kids get out of college. We're going to wait until the kids move out. We're going to wait till the kids move out a second time. We're going to wait till we're 60. And it keeps on being tossed down the road, tossed down the road. So that's what happens to that second question. What happens if there's no tomorrow? I've dealt with, and Ronen has dealt with, clients that have put things off, and then catastrophe happens. There was one business owner that I was working with that didn't do any planning, and all of a sudden he said, I have an agreement with another owner who wants to buy me. I don't need a lot of money. I want to make sure that I'm not taken advantage of. So as we started working on normalizing the earnings and seeing what kind of benchmarks and what we could do to increase the value, he was diagnosed with cancer, and he died within 8 months, 9 months. There was no contingency plan. His wife had no idea of how to run the business, and so what he was going to get for value, the proposed buyer came in and offered half of what he had told him. And so you never know when there's no tomorrow, and that's very important. They can't keep on putting things off, because sometimes that's just going to run out. We also ask them in our questions, we call them the glass door questions, what you're looking for at the other side when you're exiting. What's my perfect calendar look like? What most excites me? What is going to be my greatest fulfillment? And determining when is enough. Every business owner is different as to how much money they need to live the lifestyle that they want. They don't need to maximize value just to maximize value. They need to maximize a value that meets their individual needs. And if you have multiple owners, it's important for each owner and their significant other to identify that, because each owner has different goals and objectives. They have different time periods when they want to leave the business, and even the amount that they want to get out of the business when they're selling it. And those need to be identified to be able to help the strategy of the business going forward, so they're not running in conflict with each other, or no one's going to align to the overall goal. From the beginning of time, people have asked, what's my purpose, and have I mattered? That's an important question, and we hear it often in the business owners that we've worked with. And one particular business owner who was really very, 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 very wealthy, he had multiple businesses, and I was very saddened when I was sitting with them trying to find out from him and his wife after the, I think, third meeting of what they were really looking for, because I was the third advisor to come in. And it broke my heart when he said, all I want to hear is my son to tell me he loves me. He had completely ignored family. It was always swords up and for a win, and all he wanted to do was accumulate the most money. There wasn't enough time to be able to correct something like that. It was very sad. We tried and we worked on it, but because of his illness and his age, it just didn't get to work out. Don't find yourself in that kind of a position. And in this personal planning, which Tom will be talking about in detail, here's the value of what I have. Here's all my other assets. Here's my liabilities. Here's my other cash flows. This is what I want to be able to accomplish. I want to be able to take family trips 2 or 3 times a year. I want to go to Tuscany to learn how to cook. I want to buy a boat. I want to buy a bigger boat, whatever it might be. What amount is that? And what is your life expectancy? And then we go a little bit further, just in case you're going to live to the 90, 95, or 100. And that's what you're measuring based on where you are today, what you need to get to. And you get into, can my business help me get there? And it really depends on what the time frame is. How much time do we have to be able to build a value where you want, and do we have to decrease that because there's not enough time from when you want to get out of here? So it's a real balancing. act, but you have to be able to question and look into that. So we started here on a SWOT analysis and take a look at org structure and process and systems and the people and who do we have to hire? If we want to get to X sales, how many people do we need? What kind of management structure do we have in mid-management? So there's a lot of planning that needs to go into and the details to run that strategic plan, to be able to follow through to get you to those life goals. But at least you know when you're going into work every day that you're fulfilling this goal that you want, that's going to hit your life goals and objectives at the end of the journey. And you really need to get to understand those business value drivers as you're setting this plan, getting the team involved. You need the management team aligned, the whole team aligned. You need to be able to tie in bonus plans to make sure that their success is going to give you the success you want for your strategy plans. You have to make sure that it's a old radio, WIIFM, what's in it for me. Make sure that everybody gets something out of it and it's not just about you, the owner, of building the value up. And you need to know those critical success factors. These are the things that I just had talked about. And you need to have these benchmarks. You need to have real-time analysis based on what your goals and objectives are. And it's not just the financial goals that you're keeping track of, because there's a lot of planning that needs to go into. If you need to have some certain training, you need to have those benchmarks. If you're looking for certain hires for the management, because you can't go forward, because you won't have the customer service, you won't have the follow-up, you have to measure that. So it's not just the financial metrics as you're looking at your strategic goals. There's quite a few different things that you need to do. And as you're meeting monthly with your strategic management, for a strategic management meeting, you evaluate where you are to the goals and see if there have to be any tweaks to the action plan to make sure. And the key to all this is accountability. Any firm that's going through change management or trying to have a scale up, they're usually very weak in accountability. There's not the follow-up, and they have to have a whole separate plan to be able to do that. Ronen.
So Terry touched base on some of the, right brain issues, with running the business. And I think most business owners will tend to just focus on, what do I need to do to run my business? How do I make sure that this business is run correctly? And everybody is familiar with the terms of what you can measure, you can manage. But I don't want to gloss over some of the stuff that Terry said. I mean, this whole personal planning side of it and the ability to tie your business to what your ultimate goal is crucial to this thing. Because then everything else kind of falls into place and started to make sense. But the idea of setting up criteria for success. So ask yourself, now we're at a good time period, fourth quarter, you're looking at next year, 2024, ask yourself, and if 2024 is successful, what does that mean? How can I define that in real terms? So I can look back when I get there and say, did I make it or didn't make it? And a lot of businesses come into next year and saying, I'm just going to do better. I'll try to grow by 5%, 6%. But try to define real term, real criteria for success, I think would help every business. And those are the traits, another trait that we identified with some of what we call the graduate level of business owners. Those key performance indicators, KPIs, some people call them, they have to be relevant to what the business is doing. And you got to be able to include your managers in that process. A lot of times, business owners are afraid to share financial information with managers. We actually encourage that. Now, it's got to be done correctly. It's got to be relevant to them. It's things that they can actually impact, not just general stuff. But you can't get there by yourself. It's got to be a team objective to get there. The fourth trait, which is one of the critical one that we found to get somebody to that gradual level, is can the business operate without the owner? Now, you can look at it in different ways. You can ask yourself, can you take 30 days off? Can you work your perfect calendar of, 3 days a week, 7 months out of the year? A lot of time we found that business can actually operate better if the owner is not there. The owner is actually the tornado that kind of runs through the business and creates more chaos. But this is a crucial issue. In order for it to be a business, we believe it's got to run itself. And the key factor to remember, a business that runs by itself actually is worth more. Let me say it again. A business that can run by itself is actually worth more in the eyes of buyers. There's an old saying in private equity, they bet on the jockey, not the horse. They bet on the management team to run this business. If they got a good management team in place, they can run and do pretty much anything. The fifth traits really talks about the business owner running the business like an investor, trying to think, how do I monetize, this business to help me achieve my goals? Do I diversify my risk by taking some money out of the business while operating it and investing in other things so I don't have all my eggs in one basket? Do I simply get to the point where I own the business and it's running by itself and being able to take the returns on that business? Or do I try to take the time and stage the business to the right ideal buyer? There is a correlation, as we found, between how much control you want to maintain after the transaction to the different buyers you're looking for. So if you want more control, you're probably going to get it to your family. Try to do an internal transition. If you don't care about it and you want less control, then you're probably just fine with a third-party buyer. So those are the traits for you to look at. I'll let Terry talk about the contingency plan as we roll down towards the end.
Yeah, so as you're doing the overall planning between the business and the personal planning, it's really important that plan includes planning for the contingencies. Again, it's one of those questions of what if there's no tomorrow, right? So what you're really trying to do is identifying and start grooming the next generation of the management leadership that they can take over in the future, or more importantly, what happens if there is a death or a major disability. And you need to identify someone who can step in it. And if you don't have someone that's inside the firm, then maybe you might have to have someone come out from the outside, one of your advisors, to come in to be able to at least to stabilize the business and help get it to a place to be able to either continue to run it or to sell it down in the future. You need to keep the key management and employees with stay agreements and bonus plans. And make sure that other people are aware, the management team and the family, of what the plan is, and really make sure that they're aware. And I know that in the book, Ronen talked about one of his clients, that very successful business owner, and they had put this in place, thank God, and then it turned out that he came down with cancer. So it took a lot of the stress out of the family of what comes next now that this catastrophe has happened, because they already had a plan in effect that the family knew about. They already identified people that could run the business if something happened to him. Fortunately, he was able to fight cancer and went on to live and grow the business more and before he eventually sold it. But this kind of planning really takes, especially if you're looking at this life insurance, which again, Tom will be talking about, it really takes the stress away from the family that they're provided for, but it also could provide working capital for the business and also provide some of the funding for the stay bonuses for the key management. A lot of people are talking about, and when they're talking about the business planning or the transition planning, again, it's kid into business. There's so much right brain that's involved besides the left brain analyticals. And here are the four at top, and the fear of loss of control, of cash flow, the fear of identity, what's going to happen next, what's unknown, how do we deal with it. These are all crucial parts of the overall planning, the personal planning that's tied into business planning. And I bring them up. I'm going to talk briefly about them when I'm talking to Tav later on. And finally, make sure that you have the right advisors in there. A lot of people we see that says they're transition planners because they put it up and it's a popular thing and all that's great here. People are all transitioning out of a business. But they're only usually able to advise you or to sell you what they have in their toolbox or what they have in the knowledge. There are people that advisors that work exclusively in this area, but you need to have investment bankers or intermediaries that know this space, a legal team that knows this space in L&A and M&A and not commercial real estate. You need a great wealth management team to be able to provide some of the planning that's in here. So the planning, the team that you have is crucial to making sure that everything is done right. Good. Peter?
So, terrific presentation so far. I just wanted to, let's just take a minute right now for a couple of the questions that had come in that I think were related to what you presented. First question, kind of in the family business sector, and I know, Ronen, you talked about sort of family business is sometimes a little separate. And the question was, how do you convince an older generation that the next generation really isn't interested in taking the business over? What's your answer to that one?
Well, Ronen and I were talking about it, and my first thing is you don't convince anybody because that's just a conflict, right? But it comes down to the personal planning again with the owner and their significant other as to what their overall goals and objectives are, what's their value drivers. And during that conversation, you can find out what's really leading their thought process of why this is so important to them and determine, is that an overriding part of why they're saying this is the most important thing to me, you have to take it over. You get to explain to them of the failure rate of the second generation because people next generation isn't invested in. They haven't been trained. They don't know how the operation. They don't know how to run a company strategically. There are so many reasons why that it shouldn't just be forced on the next generation because it's doomed for failure. But that's through conversation, and a lot of right brain. It's nothing to do with left brain analytical. It's right brain, really great conversations that you dig into and you can handle those questions properly.
Got it. So here's a more last technical question, then we'll go to the next presentation from Tom. And that is, someone asked about sort of related to the sale to key employees, which was another one of the potential people who you could do a transaction with. Someone had asked about the SBA 7A and how that worked in some of the frameworks. Could you just give us, 1 minute on how that works?
I'll give you 30 seconds.
Okay.
Yeah, it is allowed to acquire businesses. It has a lot of requirements as to the industry, requirements of funding availability that they can get on their own. Maximum amount is $5 million. I think it's a $500,000 to $5 million. So it is available for purchasing, either buying somebody out that's a partner, or acquiring a business, and quite favorable terms. That does require guarantees by the person coming in. So if they're interested in it, they would have to go through the definitions to see if they absolutely require. And I have one more thing because I want to have Ronen be able to say what else they can start doing right now.
Well, I'll just touch base on your first question. There's a reason in the book we dedicated a chapter on family business because of their complexity. There's a reason why only 3% of businesses make it to the fourth generation. It's because of the intricacies of family businesses, the family dynamic, what's happening in the home is happening in the business, and why kids sometimes don't want to, be part of the business. But if the question is to the audience is, what do I do next? So I got your point. I don't need to read the book, but how do I get started? We did set up a website. There's a free workbook that people can download. All you have to do is just put simple information. You'll be able to get access to it. But it'll get you the first start of self-assessment, where you are today. Are you well on your way to operating at the graduate level? Or you've got some work to do. You don't need to contact one of us to help you. As Terry mentioned in the last slide, as long as you got good advisors that are buying into this process of that you can operate the business better and they're all working together, you don't need one of us. But you can at least get started with some self-assessment tools to get you there.
Terrific. Well, thank you both so much. I know, Terry, you'll be back for a conversation after this. And I think that's a natural sort of handoff when we talk about that team that you need to work to put together a plan. And so therefore, it's my pleasure to introduce Tom Bartholomew. Tom is the president and the CEO of Bartholomew and Company. And Tom and his firm work closely with business owners on a number of fronts, but especially when it comes to maximizing the proceeds of any major transaction like the sale of a business. So Tom, I think that last conversation about sort of putting together a team was exactly where you're kind of picking things up. So
great segue.
Thank you.
Thanks. I titled this presentation, it's the team approach to coordinating your pre-sale investment, tax, and estate planning strategies. But by way of introduction, my company's been in the investment and advisory business now for 30 years next year. And we collectively are managing about a little over $4 billion in client assets. We get national recognition for the hard work that we've done and been able to accomplish over the years. Many of our clients have been long-term clients, and we're getting a lot more business owners of this type coming to us as they reach the tail end of their journey and have accumulated their wealth. The planning process is for someone who's worked their whole life and accumulated a large asset. Let's face it, you're a business owner, you've been involved in building this business of which you can manage that risk, but now you're looking at your contemporaries who are retiring and going off with their spouses and having a good time, and you're still going to work every day. You can't afford to make a lot of mistakes because this is your livelihood and your family's legacy. Advanced planning, by definition in the screen, is the skillful leveraging of legal, regulatory, and financial expertise to enhance and safeguard your own family's net worth. The key word there in my mind is advanced. Planning doesn't happen at the time of sale. Planning doesn't happen properly and holistically if you wait until you're thinking of selling your business. Planning, like any other exercise that you do in your business, is about planning for the long term. So the objectives and benefits of advanced planning, doing it in advance of the sale, doing it in advance of your retirement, are very important. It's the old story about the business owner sells the business, goes home, retires, wakes up in the morning and goes and sees his wife at breakfast and says, "Hey, honey, what are we going to do today?" And she says, "Well, I know what I'm doing today. I don't know what you're doing today." So we don't want to have those problems. We want to do some advanced planning along the way. There are 6 key areas that we've identified of financial planning listed on the screen here today. I'm not going to try to cut through all of them because behind these 6 key areas are 54 subsets of different exercises in the financial planning exercise, whether it's retirement planning, estate planning, legacy planning, risk management, budgeting. I can't tell you how many times I talk to successful people and we start to talk about what they're going to do in retirement and how they're going to pay their bills and how they're going to live their life and what they want to do when you're, on a relative basis, very young and healthy and going to enjoy the fruits of your labor and spend a fair amount of money coming out of retirement. And then you're going to go into a period of time where you begin to slow down. So we want to be able to plan for these things properly and be as tax efficient as possible. These 6 key areas of financial planning, as I said, they break down into all of these subsectors, and I think Peter said that we're going to have a distribution of some of these screens, so don't try to write them all down. I'm not going to spend a lot of time talking about them, but it can be everything from simple budgeting, managing risk in your portfolios, your daily life, your business life, investment planning. What do you need? What do you want? What are your goals for your family, for your heirs, for your own children, your grandchildren, your charities? Retirement income planning. Oftentimes, a business owner makes a fair amount of money. He or she is running their own enterprise, and they sell the enterprise, and they haven't done the planning to figure out what their income is going to look like in retirement, and it may not be quite as much as you think, particularly on an after-tax basis. You've got to plan for it. And then the estate planning piece is really an enormous thing. And I've listened to what Terry talked about, these people who plan their whole lives and work their whole lives and get to retirement and then pass away quickly. Hopefully they've had the opportunity to do some significant and proper estate planning for their families. The estate planning piece that pops out of the wheel here and the tax planning is important. These are the arithmetic pieces. And the investment planning is to determine how much money you can afford to spend in retirement. These are tasks that are ongoing. It's not one time. You don't create the plan and walk away from the plan when the event happens. This is something that requires regular annual review. It requires market. As you know, we're all in very, very volatile markets these days, investment markets. How am I going to generate my income? Where's my income going to come from? What's my tax advantages going to be? What are my tax challenges going to be? Need to know this all in advance of doing the sale. Too many times we see people who don't spend enough time and don't surround themselves with the proper professionals so that when they get to the point of liquidating a large asset, whether it's a big piece of real estate or it's an operating business, I had an accountant come in one day who sold a practice and said, I've got money in my account, we sold the business, I now have to sit down before I can figure out how much money I can invest, I have to figure out what my tax liability is. The accountant said that to me. Thought that was very interesting, Terry. It wasn't anybody at your firm, thank God. So we've got to work with people to make them aware of the need and necessity. And as an independent investment advisor and financial planner, we have the experience in my company to ask these questions and help you work with those people you surround yourself with, the accountants and the attorneys, to make sure that you're maximizing what you can do and you can live comfortably and plan to pass your assets on to the family that you want to. The estate planning piece is multifaceted. The attorneys, I'm not an attorney, I don't give legal advice. I read a lot of legal documents and I read a lot of wills and trusts. Many of them work, some of them don't. If they haven't been looked at for a long period of time, and when you drafted your documents and your children were young and you had them in place because somebody convinced you to do that, that's a good thing. Now your children are older and you've got grandchildren, and some are in your business, some are not in your business, some want to be in your business, some don't want to be in your business. And your children, you've identified people to handle your affairs. You did that when you started your business 20, 30 years ago, even longer maybe. Those people are now older than you, and they're probably not going to be around when you need them because they're going to pass before you do. You've got to review your documents, make sure that they're appropriate for the times today. Trusts are multifaceted again. If it's a tax strategy, to make sure you're maximizing your ability to pass money on to your heirs by use of trust vehicles between you and your spouse. If there's irrevocable trusts, planning for healthcare costs in retirement and elder ages. If it's tax strategies and charitable trusts, life insurance trusts have a particular use in estate liquidity, which need to be reviewed, funded, documented properly. And special needs trusts, unfortunately, some of us have family members who are not able to care for themselves or have limited ability to care for themselves, and we've made a lot of money, maybe, and we need to help establish care for these people, our children, our grandchildren. I have a client in Florida right now who's got 3 grandchildren who are all on the autism spectrum, and we're funding trusts to take care of these grandchildren because the rest of his family can't do it. The old adage is it's not going to happen to me, it's not going to happen to you, but it's going to happen to somebody. And we've got to be aware of these kinds of things. Durable powers of attorney, one of the standard documents that comes out of an estate planning exercise, are not always durable if they're really old. Many companies like ours would look at a power of attorney that was drafted 5, 10, 15 years ago, and it won't stand up anywhere because the financial institution has liability to act on that power of attorney, and we don't know if there's been a power of attorney that's been issued since then. So reviewing the documents and making sure the documents are somewhat current is very important. The living will, the healthcare proxy, is a document in your estate plan which allows you and your family to decide if sustaining life makes sense, essentially, and who's going to be responsible for having that. I had mine and my dad. My mom passed away years ago, but my dad, I was his agent for his at the end of his life. Never a fun thing, but it's important to have it so somebody else is not making a decision for your family. The HIPAA release form, the Health Insurance Portability and Accountability Act, is very important today. You've got to have the ability, even for your own spouse, to be able to get medical information for you if you're not able to act on your own behalf. The hospitals are not necessarily allowed to release information if you're in the hospital. Standard documents, these documents are standard package to be considered, to be updated, to be naming people that make sense. Some people, I had one client who had a HIPAA release naming a child that he doesn't have a relationship with anymore for family reasons. You got to make sure that the people who are representing you, whether they're your personal representatives, which used to be called executor or executrix, or your trustees of trusts that be held for your spouse, your children, your grandchildren, your heirs, distribution to charity, all those things have to be thought of and looked at on a regular basis and kept up to date. We work with people all the time to make sure that all of this part of their financial plan and their estate planning process makes a lot of sense. This has got nothing to do with managing the money. That's a whole separate exercise, and when we get paid to do that as well. This is all about making sure that every piece of your financial plan, when you sell this business or you have this big capital event, it also, if you're inheriting a lot of money, let's face it, some people have the parents who have made a lot of money. And we've got to make sure that these things are handled properly for generations to come. Tax planning. We talked about it a little bit, but business sale, coordinated approach to your tax, legal, and consulting business advisors. Have the conversations with your tax professionals before you sign to sell your business. It's not that difficult. It's a key part of it. All too often, we see clients who don't know what the tax liability is after they sold the asset. I sold a building for $5 million, and I just found out that I have depreciation recapture. And I don't even understand what that means, but I understand it's going to cost me a lot of money. Whoever sold the building for you didn't do their job properly by advising you that you need to look at that before you sold the business, before you sold the piece of real estate. Same thing with a business. Don't wait. Do it well in advance of the sale so it's all part of a long-term permanent plan. Know the difference between capital gains and depreciation recapture. Know the difference between a stock sale and an asset sale. What does it mean to the proceeds, and what does it mean to your tax liability? Got to work with you. You have to find a good accountant who knows what he's doing. We have one of those in the room today, certainly, who can help. But these are questions that need to be thought of and need to be dealt with before you determine whether or not you want to sell the business to somebody else. The timing. There is estate tax planning tools available to us today that may not be available to us in a couple of years. Under the 2017 Tax Act, the federal exemption for estate taxes currently is about $13 million. You don't pay taxes on the first $13 million worth of assets when you die. Neither does your spouse. So if you have a lot of money and you're selling your business for a lot of money, you've accumulated a lot of wealth, you can exempt the first $26 million from federal estate tax purposes today. January 1, 2026, the law currently states that number will be reduced to somewhere between $5 and $7 million, back to what it was before the Tax Act of 17. That's important. It's important to know whether you should be gifting some of these assets away prior to January of 26, to be prepared to do it if that legislation is not extended. Some people will argue that Congress is going to extend the legislation. All I can deal with is what I have on the table today. Do the advanced planning, be prepared to do it, do some of it, do part of it, get it out of your estate, pass that along to your children somehow. Those sunset provisions are real right now. Whether they're there in 2026 or not, we'll find out when we get there. Determine all the different methods for selling these assets, whether it's a cash sale, it's an asset sale, whether you're taking back equity in a publicly traded company. I have a client who sold a manufacturing business in the county a couple of years ago, and he got a fair amount of cash, and he got a lot of stock in the company that acquired him. It's like the old story about the guy who sold his business to Berkshire Hathaway 40 years ago and took all stock. Everybody thought he was crazy. He's not crazy today. But tax planning is key to the efficient success of these transactions. The investment planning piece that we always talk to people about is portfolio risk tolerance, liquidity and flexibility, income capital gain tax planning, estate considerations and distribution, charitable considerations if you have charitable intent, and any special needs, any special family needs. Portfolio risk tolerance, I can honestly tell you that in my business, I think that we bring a lot of discipline to the process. If you have money invested in public markets now, in stocks and bonds, you've noticed the volatility that we are dealing with in these public markets today. Markets are up and markets are down a lot and way too often. And if the planning process has got to be able to look beyond the short-term noise to the long-term planning and have the stick-to-itiveness to stay with a plan. But you've also got to pay attention to cash flows. I worked my whole life. I built up a big business. I sold it for a lot of money, and I want to go off and enjoy time with my spouse and travel and do all the things I can do while I'm healthy. Have those plans in place long before you sell that business. Plan that life in retirement. Don't be that client, that person who comes out of the bedroom the first morning and doesn't know what they're going to do with themselves. It can be anything. You can go sell, as I said, you can go sell nails at Spags. That's a local joke that somebody might understand. You can give yourself to charity. You can put yourself into another business. You can put yourself into a lot of different areas, but don't wait until the end. Liquidity and flexibility. Terry will tell you that this is true. That many people, the largest asset they own is this business, and while they own it, their liquidity is really not very good. So if you die with an asset that's not liquid, something that you have a hard time selling, I think Ronen talked about the fact, Terry talked about the fact selling it when you don't have to makes a lot of sense, because if you're not there to sell your company's probably not worth what you think it's worth if you're the driving force behind that company. Creating liquidity. Too many clients come to us with a lot of assets in hard assets, a lot of assets in retirement plans, a lot of assets in their homes, and not enough non-retirement cash to cover opportunities and emergencies in the balance of their life going forward. One of those emergencies and opportunities, I guess, is to pay tax. If I have to sell an asset to pay Uncle Sam's dictating when I get the money back from the sale of this asset. I don't like having Uncle Sam telling me how to raise my money and tell me when I have to do it based upon the fact that I unfortunately passed away and I'm not here to defend myself. Income capital gain tax planning, tax loss harvesting in your portfolios. We spend a lot of time every year working with our clients to make sure that if there are assets in portfolios that have not performed well, we're going to book tax losses in the portfolio in the event that we need to use those losses against gains in the future. It's just smart work. Loss carry forwards are a big deal. But consult with your tax professionals. We can figure out what the tax losses are. You've got to talk to your professionals, whether you've got capital losses or you've got operating losses going forward from other businesses that can be used. Estate conservation and distribution is what I'm talking about when I'm talking about efficient tax planning for the distribution of your assets to the next generation. How do you do it most conservatively and most efficiently? The state of Massachusetts increased the estate tax exemption last month, October of 2023, from what had been $1 million exemption for many, many years. I don't remember even how far back it goes. They increased it to $2 million in Massachusetts. And it's something that needs to be dealt with between spouses. Charitable considerations. If you have charitable intent, and I tell my clients, I want it to be your charitable intent, not somebody else's charitable intent. But if you have charitable intent, whether it's educational, whether it's healthcare, whether it's the arts and sciences, whatever you like to do, how do we build that into your estate plan so that it's your gift and it means something to you and your family and you can leave that legacy? Some people have that kind of consideration, others don't. Not everybody needs to have it. The special family needs, the special family considerations I spoke about a moment ago, there are many. There are very many. Every one of our family members has the same ability that we have in starting a business to be able to provide the same way we did. Do we want to take care of those people, take care of them so they don't waste the money? I've got plenty of second generation children of wealthy clients who don't have the same business acumen, and they're going to have tens of millions of dollars in a trust for their benefit, and given their own methodologies, those monies may not last their lifetime because they just don't know how to handle it. So special family considerations are a big key in this process. What is the measure of sound financial and estate planning, to wrap up? It's not only how much money you make, I think I heard this previously from the prior presenters, or how much money you keep, but how you best use your accumulated wealth to benefit yourself, your spouse, your heirs, and others for years to come. There's little to be gained by waiting. I think there's nothing to be gained by waiting. If you are a person of substance and you're thinking about this, don't wait. Plan ahead. It's much more efficient. It's much less expensive for your heirs. You don't die without a will. Don't die intestate. Be the person who does the planning in advance and know where things are going to happen. Thanks.
Tom, thank you. That was a great presentation. Let me share with you one question that came in while you were speaking. And the question was, what can a business owner expect to spend on the planning process of selling a business? From consultants to sort of pulling this team of professionals together. And let's just say, for instance, it's $1 million business or a $10 million business. Is it by scale related to size, or is it sort of a similar fee?
Interesting question. I mean, the generic answer should be that that the size of the estate is, in terms of monetary value, does not necessarily dictate the cost. A small estate can be very complex. A large estate can be very simple. I think one of my largest clients has got 3 assets now in retirement. He's got a big investment portfolio, he's got some real estate, and he's got some trusts. Not very difficult. It wasn't difficult to get there. He liquidated his business a number of years ago, and he's had nothing but cash ever since. A smaller estate, a smaller business owner with a smaller, less than the $1 million number that you talked about, the $5 million number, it may be more difficult. It depends upon the family considerations along the way and what they really want to do. They may want to do they may want to set up a charitable foundation. They may want to take care of people outside their family. We have special trusts for all kinds of things. So there's no homogenized answer as to what it's going to cost. It depends upon the individual.
Terrific.
Right.
Tom, thank you very much. That was a great session. And we've got one more moving part left to our presentation this afternoon, and that is a conversation with a real business owner who went through a transaction. Terry's the managing, who's been up here earlier, managing partner at S&G, and one of the founders of ROCG Consulting. And we're also going to invite, so Terry's going to sort of have a conversation with Altaf Sheikh. Altaf is the founder and the CEO of ListEngage, which is a company headquartered in Framingham, but that has a national platform. And Altaf, he's a founder who sold his interest to a private equity firm, and he took some money off the table, but also maintained, some of his equity in the organization. And he and Terry are going to kind of have a conversation about his experience, as well as his current position as CEO of the company within that new ownership group. So, Terry, take it over.
Great. Altaf, thank you so much for coming and sharing your experience. I think it's going to be of great value to everybody that's partaking here in the webinar. So let's start off with a brief description of what your company does so they have an understanding of the platform before we get into the questions that you and I talked about selling the business.
Great, very good. Thank you, Terry. My pleasure to be here. What ListEngage does is we are an email and a mobile marketing platform. We are a services organization in an ecosystem of marketing technology companies, if you will. And what we help companies do in its simplest form is to bring lots of their data together, put it all together, create beautiful looking emails, and send it out to our company's customers, if you will, mobile messages and email messages. What is complicated and behind the scenes is important to know about our business is when you receive an email from Amazon or your tracking company or what have you, it might have your first name. It also has the products you purchase. It also has something else you can buy. It also has an unsubscribe link at the bottom. All of that can be done without proper planning. It requires a lot of data to be brought in, normalized, put that email together. There's a lot of art and science behind building an email and mobile message, and that's sort of what our company does. But we do it in one ecosystem. That's why we are specialists and not generalists. We do it within the Salesforce ecosystem, Terry, and that's the company that we have built. I've built over the last 20 years.
That's great. Thank you. So why don't you tell us, what was your reasoning for selling?
Yeah, I mean, I think a great conversation earlier, learned a lot from all you folks, and I've kind of lived that in so many ways. But the short answer in why to sell is when I was deciding to do this, it wasn't a distressed sale. We were doing really well. I had some great accountants, thanks to Terry, your firm. We actually work with a partner in your firm. We managed our books regularly. We had details planned out. But we live in a dynamic ecosystem. The marketing technology ecosystem was changing right in front of us. We had built a great company of 50 employees that were happy in our organization. But as the MarTech ecosystem changes, Salesforce was acquiring the company that we used to work for, we used to be partnered with, and all of a sudden, there were fairly large systems integrators that were jumping in our ecosystem. And as an entrepreneur, I want to lead with passion, but I also am productively paranoid. I've built a great company. It's important to me, and it's important to the employees that work in the organization. And I don't want a really large organization to take a step and say, we're only going to work with systems integrators that are $1 billion in size and have 5,000 employees, and we're going to use them for services. We were a smaller company. We were niche. We were boutique. We were doing great work in the ecosystem. But that productive paranoia made me look at what else I can do. And the whole idea behind this was I was an entrepreneur. I had grown the company to a certain extent, but beyond a certain size, you need scale, you need compliance, you need pipeline management, you need a little bit more discipline, and I needed a little bit more of a management team next to me and a phenomenal board who would be able to help me do this. So it wasn't a distress sale. I wasn't looking to get out. That's part of where due diligence came in, and I said, we're going to take this current company, exit, and build something more phenomenal, and there's going to be a second bite at the apple someday, which is sort of the step where we are at today, 5 years post-sale.
Yeah, no, that's great. And what you're describing is goes back to one of the slides that we had up there about that SWOT analysis.
That's right.
And so, we'll take the T out of the SWOT, because what that was is a threat from the industry.
Right.
So you realized where you were, and then made the decision of where you had to strategically go down the line to be as successful as you are now. There was also a personal reason, though, because you had told me, share with me, besides wanting to make sure that these bigger companies didn't come in and steal your space.
Right.
That you personally, it was also taking some of you told me the chips
exactly.
off the table.
That's right, exactly. It's a great question, great point, right? As you grow a business and you run a business, you want to be able to take the company to the next level, but you also don't want to be holding on to all the risk for us and for our employees. We had employees in the business that also had stock options and so on and so forth.
Yeah.
And it meant that I was taking all the risks. So by doing this, what I would be able to do is take some chips off the table, plan, and not just be an entrepreneur. I call myself, despite the success, a perpetual struggling entrepreneur. An entrepreneur is always chasing the next dream, right? So I call myself a struggling entrepreneur. I wanted to be able to take some chips off the table and then build another company along the way. And that was good. That helped me actually be a happy achiever at the end of the day. I wasn't always just in the business worrying about, we would have a phenomenal year, December 25th, and immediately half a day would go by and I would start thinking about the next year. That worry is good, but I needed more of a management team around me to be successful and growing. And taking those chips off the table made me do business in sort of a lifestyle or a model that I wanted to, and made me give to the business and to the ecosystem in far more greater ways than I would have been if I was just without taking the chips off the table, Terry. So it was immensely helpful.
Yeah, and for the personal lifestyle, because when we were talking, you were ready to leave because you had to go pick up your kids and a dog. So
that's right, exactly.
Otherwise, you'd just still be behind the desk. So
that's right.
It was great to have the organizational team.
Right.
So what was the process and criteria of choosing the investment bank or the intermediary that you chose? How did you get to choose them? Because you had lots of choices, I'm sure.
That's right, exactly. So I think it's a broad question, and I think depending on the space where you are, certainly I think you want somebody in your ecosystem. Investment banking, I think you want to be able to work with somebody that has sold your kind of business in your ecosystem, in your domain, and so on. Then you've got the context, you understand the models, you understand the multiples, you understand the challenges that you go through, right? But investment banking is tricky. Sometimes you choose an investment banker, and sometimes your market size dictates who you want to work with. If I wanted to work with a really large firm in Boston at one point of time, but they weren't the right fit for us because we would have been a small fish in a big pond, I would have gotten to work with some junior analyst out there. I wouldn't have had the interest of their senior advisors or what have you. So I realized that. I was also a part of a CEO roundtable forum for many, many years. Some phenomenal CEOs were part of it. I had seen them go through successful exits and failed exits at the end of the day. So I had learned a lot that an investment banker was important, the right size and the right choice was important too. So I didn't want to be a small fish in a big firm and not get paid attention to. So what I chose was somebody who had great business selling experience, and we would be a priority client for them. They would kind of pick up our phone on the first call, give us the time needed, and be able to spend time with us. That was important for me. So that's sort of how one of the criteria is. And then they absolutely had success in their repertoire. Not exactly in our domain. One thing I would have probably changed is look for somebody specifically in our domain, but we're also very specialized, so it's hard. But I think those were some of the criteria I looked at when I chose an investment banker, Terry.
Yeah, I remember when we talked about you had mentioned it was all about asking the right questions, right?
That's right.
And at least this smaller intermediary that you brought in, I mean, you told me that, I mean, you started working on your book and you actually took about 6 to 12 months just to write the book up before you went to market.
Right.
So there were some things that I want you to explain of what you were working on, you know, how you were trying to increase value, you were trying to make sure that someone came and understood and it set you up in the marketplace properly. And you told me that this smaller firm, they actually stayed with you and worked through all that versus saying, come back and see me when you're all ready.
That's right.
So we're going to
exactly.
talk about that process of what
Absolutely,
you were doing?
Terry. Great question, and that's sort of where planning comes into play at the end of the day, right? I think the way I think about it is you've got to be able to take your business and say that's sort of the exit. But prior to exit, you've got to be able to dress up your business. You're constantly working in your business and you don't want to take the eye off the ball, otherwise the business loses focus, you can't gain revenue, you can't get growth, and so on and so forth. But selling a business is a full-time job as well. So you better hire the right advisors, better hire the right bankers, and so on. So we went into this process because they didn't belong to our industry. It was as much me training them about our business as they knew as when they were writing the book. So they were kind of taking a first stab at it. I was revising. I'm a perfectionist at that. I want people to look at our business the right way. So the process of writing the book itself took a while. Then came the teaser. But alongside that, I was also working with the recommended accounting firm and an external accountant, if you will, to dress the business up. I mean, nothing wrong, but dress the business up from an earnings perspective, from an EBITDA perspective, from a margin perspective, from a growth perspective, to put all that in play such that when we were ready to go to market, we weren't unprepared, right, at the end of the day.
Yeah.
So all of that process took a little while. The process from start to finish before we even went to market was about year and a half. And the paperwork that we had in place with the smaller firm, that's sort of why I said it's important to be a big fish in a smaller pond. That's sort of what we were for them. They stuck with us throughout the entire process. Their proceeds were going to be at the end of the sale. So overall, it took about 2.5 years,
Yep.
maybe even slightly more throughout this entire process, but they stayed with us through due diligence, putting the book together, putting the business in order, and then being able to sell it finally.
Yeah, and that's an important point for the audience or the business owners, that it's not just waking up one day and saying, I'm ready to get out. I'm going to sell my business and we're going to list it and it's going to be sold. I mean, it is a process. It's a process for planning and a process to get to market, and then a process through the market. Never mind all the due diligence that has to come after it. So I'm glad you brought in how long that process is, and that you need to jump on it and start the planning earlier than later.
Yeah, I've often felt, Terry, that success in a business is half passion and half perseverance. You've got to be. It's easy to fall in love, but it's very difficult to stay in love, right? Doing the business. My perspective always has been bring the right amount of passion, but you have to persevere through it, and you've got to be able to take a look at your round table, your advisors, and learn from the best. My round table and my advisors are like my informal Harvard Business Review forum, or my HBS, if you will.
Yep.
Learning from them, their success stories, and so on, has meant so much to me at the end of the day, right? Yeah.
So you had several letters of intent. So tell us why and how you chose the eventual buyer.
Yeah, exactly. So it was a process. Several folks came in before the company that we decided to go in, and I won't take names, I won't go into numbers and what have you. But at the end of the day, because it wasn't a distressed sale, because my mission was clear, I wanted to be, whether CEO or some C-level executive in the next company, I wanted to serve the ecosystem. I wanted to make sure that our people were taken care of. And I was still fairly young 5 years ago when I was selling my business. So I still had enough gas in the tank to go run and do this all over again and get a second bite at the apple, right? So I think what we chose was companies who said, look, we're not just, it was a private equity group that acquired us. It wasn't just a roll-up. We're going to, PE firms come in very clearly and sometimes tell us, we're going to acquire you, we're going to acquire a complementary technology, and we're going to roll you guys up and we're going to sell you off to the next one. Nothing wrong with that if that's exactly what you want. And there's a gold at the end of the rainbow, or what have you, part of gold at the end of the rainbow. But in this case, I knew that we wanted somebody that was in it for the long term. So folks that came in, that finally acquired us, came in the due diligence process and said, Altaf, what we want to do is build a bigger company. What we're going to provide to you is you have the passion for the ecosystem, you've got the culture key down within the organization, and you can connect the dots within this large Salesforce ecosystem or the marketing tech ecosystem. We wanted to run the company, operate the company. We will come in and provide the financial scale, compliance, HR, sales and pipeline management, and so on and so forth. As an entrepreneur, I ran things from the hip based
Yeah.
on my gut at the end of the day, but we needed an operator to come in and work behind the scenes to take my vision and put that into practice. So when this company came in and said, it's not going to be a year, 3 years, 5 years, we're all going to work together to get to a certain point where our ecosystem says there's going to be a phenomenal second bite at the apple at that number, and that's when we are going to go for a second exit. So hearing them, holding them to it a couple of times during the discussion
Yep.
was important, and they repeatedly said it. Now people change, anything could have happened post-transaction, but asking that question several times and hearing from them what I wanted to hear was very key to me, Terry. And that's sort of why I chose them, in addition to the price being right and the team feeling right.
Yeah.
And there was tremendous chemistry while we were doing the process. We had our differences, but it's a process.
Yeah,
At the end of
and
the
I think
day.
it's the important part of that for the audience is the planning and knowing exactly what you want to get out of a transaction. You don't want to be making those decisions, should I, shouldn't I do, 'cause as you have these different private equity or potential buyers coming in
That's right.
and making certain offers, and then they're nothing close to where you ended up, what you wanted. You want something very specifically, and you found it. Other people might just be lost in the decision process,
Right.
phases process. Okay. So all the business owners that we worked with, and we alluded to it as we went through it, have had some of those emotional issues, right? That could be landmines,
Right.
especially with the family or what have you, of the loss of control and the loss of cash flow. I'm going to do this, and what comes next? Fear of unknown, because they haven't decided, as Tom had talked about, what comes next.
Yep.
Right? You should be walking towards something
That's right.
versus I'm exiting my business. Did you go through any of those? I mean, through this whole planning process and the thought process, I'm going to put it up, and I'm going to put it for sale, and I'm not going to have complete control, and who knows how great these buyers are going to be coming
Yeah.
in. They talk a good game, but who knows? But did you tell us
Absolutely.
about how you felt some of those?
It's a huge change, Terry, in your life that you build a business. It's the biggest asset, like many of you folks have said, and to be able to sell it, right? You constantly worry about the next chapter and the people that are going to be in your life at the end of the day. I've gone through it. I'm human. I felt like it's okay to have an imposter moment. You worry about this, but it can become a syndrome, right? So
Yeah.
I told myself I'm going to curtail it by making it an imposter moment where I worried I was going to go to my advisors, ask them for advice. If it felt right, we were going to continue. If otherwise, we weren't going to continue. So I think it was important to understand that. And did it happen? Absolutely. I think I worried about it and went into it. And I think, acquirers are smart people. They do this for a living. Private equity groups and strategic buyers are amazingly smart people. And we were a smaller company at that point of time. They could say a number of things and they could come in and change their tune on day one. But what is important in all of this, if you're going to sell to someone, is are you in it for the long term? And if you're in it for the long term, they don't just acquire you because you look good or you've got charisma. Can you stay your course? Are you smart enough to be with them and provide value on a regular basis year over year? We were acquired in 2018. It's 2023 today. We've quadrupled our business since that time. And I've continued to remain CEO with an amazing COO by my side and a great board. But I feel that relationship has maintained because I've brought enough value to the table on a daily basis in being able to connect the dots, in being able to be a visionary, in being able to provide great culture key for my company, and doing all of the things that probably some of them can't do. But I've got also got an amazing integrator behind me who takes away a lot of my worries. So I think as you go through a process, as you sell, if you are going to remain in that business, what is absolutely key is, can you hold your ground? And I was able to, with my talent, with my engineering background, and with my vision, be able to go toe-to-toe with some of the smart people that came in the business, and we were able to grow it together. I will tell you that I think, however nice the acquiring company is, if you can't hold your ground in year one or year two and the results aren't great, you might be out as CEO. And that's sort of where you got to be able to plan for, what does that exit look like in your contract, right? For cost, without cost, whatever those terms and conditions are. But that's sort of my perspective, because I was able to hold the ground, provide value. The board, our management team really likes what I'm doing, and I like what they're doing, and hence there is a symbiotic relationship and partnership at the end of the day, Terry.
Great. So let's briefly just talk about the sale process. I mean, you had to go through the letter of intent or letter of interest, the due diligence, the legal structure, employment negotiations, earn-out negotiations, closings. So good and bad, ugly stories, lessons learned, issues you faced and had to go through at a 30,000-foot level. How did you handle things? All these things, certain parts you didn't agree with, I know,
Yeah.
and you had to work them out. So why don't you share some of those stories of how you handled things, especially working with, well, we'll talk about your employees next question. Go ahead.
Right, exactly. I mean, I think, it was a stressful time. There is no doubt about it. It was an exciting time for what was going to happen, but it was also a stressful time. And I kind of looked at it and I said, at the end of that stressful time is going to be a pot of gold, is going to be, at the end of working hard is a touchdown. At the end of taking some risks in life and learning a new skill is when you become a better person. So it was stressful. I was going through all of those emotions. But what I would say is that I think I mitigated a lot of those risks, Terry, by having the right people by my side. I knew one thing that I want all entrepreneurs or folks that are looking to sell their business is to realize your strengths. My strength was technology, my strength was people management, my strength was being able to connect the dots and being an entrepreneur. My strength wasn't financial management. My strength wasn't tax planning. My strength wasn't being able to write a great book to sell our business. So by going to the CEO roundtable, by coming to bankers and by coming to accountants like your firm and so on, I had built that interest, that acumen alongside me, and I took my folks with me. So the period became long but less stressful. What I would say to myself is the stressful part was the longevity of the process itself. It took a while, and every day there was something new. Accounting firms asking questions on the other side. The due diligence was stuff. Caveats, the covenants were there from the bank, and term sheets and papers, or governance and control. Term sheet is about that, as simply as governance and control, right, at the end of the day. But there's a lot of details that you as an entrepreneur, as a technologist, doesn't understand that. You got to be able to build a team of advisors. So I think the length of the process was quite a bit. I felt at times that I was taking the eye off the ball from the business. So I had to inform a few people in the organization that we were going through the process, and they were able to help me. So I think more than horror stories, yes, there were some heated discussions and debates during the process. Until the very end, there were some discussions.
Yeah.
But the other party knew they wanted to make this happen. I knew that we wanted to make this happen. And we all came together despite those tough times to be able to look at what the future might be.
Yeah. And one of the things you had mentioned to me when we were chatting the other day was that, yes, with all this going on, and you never know, though, what's going to happen until there's a signing of the bottom line.
That's right.
Because anybody could walk away at any point.
Absolutely.
And that was an emotional issue.
That was an emotional issue. And we actually had an opportunity like that just before the current folks came in. There was another opportunity that had come in. We were fairly close or going in the trenches with them, and they had to walk away because I didn't agree with something within the term sheet or what have you.
Yeah.
So it absolutely can happen. I had gone through that. I knew it could happen again, but I also felt like these folks were committed. I was committed. There was a relationship and sort of that was being built, and we could kind of bank and cash on that. At the end of the day.
So new company onboarding, your transition. So I think you had 50 employees, now you have 130 if I'm remembering
That's
the
right.
numbers correctly. So day one after the sale, how did you handle that with your employees? You were hopeful that they were all going to stay.
Yeah, absolutely. It's a great question. I think it was, I think if I had looked at it as day one after the sale, we would have been in trouble. We would have absolutely been in trouble. I think we had our employees that were vested in the organization. They had left larger organizations and come to work for us. And they'd taken a risk in joining a smaller company. If I didn't inform them ahead of time, and I wasn't telling them that this was the day of the sale, but I was telling them that there are certain things that are going on in our ecosystem that's a paradigm shift. We've got to be able to cover our bases. We've got to be able to protect our company and you employees, and I want you guys to get a better future, travel to better places, get a better pay package, do better work, and so on and so forth. And you have somebody at the helm that's looking out for you. So if something happens in the next 6 to 9 months to 18 months when I was doing that process, I kept telling our key employees, Bill Gates said it. If you take away 20 of our most amazing people in our company when they were really young, you had no company. That was my company as well. If you took away 20 of our absolutely smart people from the organization, we wouldn't have been who we are today, or even 5 years ago. So those 20 people I had one-on-one conversations with and kept informing them, not about the date of the sale or when the sale was going to happen, but informing them that I'm looking out for the organization and for all of them. And I think when the day came about, when the week came about, I was able to go on a phone call with a couple of them and say, we are at an amazing point in our company where we're going to work with an amazing board, a better management team, better pay structures, better employment agreements, and more opportunities to grow, and possibly a second bite at the apple.
Yeah.
And I think setting that stage was very key. And then when the day did come in, we announced it as good news. The COO moved in from Florida to Boston. And one thing we did was, look, I said, people had joined our organization for the love of our ecosystem, but also because I had the culture key. People believed in me. I convinced each and every employee to come work for us. People said, we've come to work for Listingage because of Altaf and his charisma a little bit, and then the ecosystem, and then the company or what have you. So I was able to tell our COO to spend the first couple of months just listening to our people, schedule an interview with every employee in the organization, listen to their pain points, listen to what they say about me, ask candid questions, get to know these people, and then have a follow-on call with some of them. So our COO who came in actually spent a significant amount of time in the first 30, 60 days just learning the company, getting to know the people. I said, we've got the bases covered here. We need you to do a lot of great things, and it's going to happen over a period of time, but the wrong thing we can do is rub people the wrong way, not understand them correctly. If you can't get on their right side, these are the people that have spent a decade in our organization. If you aren't able to spend time with them and get their confidence, we will be starting off on the wrong foot. It will be me versus you and the organization, and we all need to row in the same direction. Yep. It's very hard. If I'm rowing here, you're rowing there, some employees are rowing in the other direction. Why have that friction? So I think what we did right was get the other operating officer and the board to introduce themselves to our team and build that camaraderie and rapport. Terry.
I'm going to have a last question, but I just want to follow up on that, because I thought of before you sent, was it Brian?
Yes.
The CEO out to talk to them, you had talked or made a presentation to your employees of, listen, it's the unknown of where we're going. I think we're going to we're doing the right thing.
Right.
Don't leave the company to go to a devil you don't know.
Yeah, that's a great point.
Stay with us. Hey, and if they're not the company and not doing the things they say we want to, what I think they're going to do for the culture,
right,
then you leave in 3 months or 6 months.
And that's a great point, Terry. You reminded me of our conversation. I did tell people who were nervous about this opportunity, and I said, you've been here 8, 10 years, 6 years. As somebody looking out for you, I'm making a big promise to you. We're going to go on an amazing journey. What's another 6 months to a year? You're getting a little bit of stock options right now and so on. You're getting to work for a bigger and better company. If I don't live up to my word over the next 6 months or a year, or Brian who's coming in doesn't live up to his word of taking this company to the next level by building a great culture, you always have the option. You guys are phenomenally talented people. You can get a job any day in the ecosystem. A lot of them believe. We only had one employee who was significantly worried about this. I don't know why. He left the organization and he's since changed 4 jobs. I'm not disappointed. Yeah. I'm disappointed that he left our company for him, because he would have had a phenomenal career here as well. Everybody, we've got amazing retention rate. Very few people have left the company.
Yeah, I think you did a great job. The communication from our conversation, you did a great job. Last question, so we can wrap up.
Sure.
Give us 3 key takeaways you'd like to share.
Wow, 3 key takeaways. I think building a company is not easy. It is a 24/7 job. I often go back to the building the wall story. 3 people were building a wall. Somebody asked the person, "Oh, I'm laying a brick." The person said, "I'm building a wall." The third person said, "I'm building a cathedral here. I'm building a church here," right? There's got to be a bigger mission when you're building a company. My mission was to do phenomenal work in the ecosystem. So as an entrepreneur who's building a business, I think great passion and then to be able to persevere through the business is key. Way too many times, great ideas come in, but execution doesn't happen. So building a business, that to me was key. Second, I think do right by your people is the one thing I've lived by. Culture is important. Culture is that word that way too many people throw around but don't build. And I think from the top down, you've got to be able to build that culture. Growth brings complexity in an organization. Complexity will create problems, and problems will mutate in an organization. But when you're working in an organization, will you do your job or will you do what's necessary? And you do that only because there's great culture, because company employees believe in you. We have an organization where people are in front of our clients all day long. I'm not micromanaging them, but that passion comes through on client calls because we build a great culture. They know they can be here, they're making a difference. They're a linchpin in our organization and not a cog in the wheel, right? That's the second thing I would say. And the third thing, because this is about selling businesses and stuff, I mean, it absolutely takes a village. I will just say it in my own words, it takes an ecosystem to build a company and to sell a company. Be a part of a roundtable, be a part of Toastmasters, be a part of a roundtable where you learn from businesses similar to yours. Associate yourself with people that are smarter than you. If you're the smartest person in the room, it's time to probably leave the room as far as I'm concerned, right? You've got to be able to work with accountants and folks, advisors, lawyers, investment bankers that are smarter than you. You became the CEO of a company because, from my perspective, an engineering niche or what have you. But I didn't have all of these other things going for me. I built an ecosystem around me. I leaned on them heavy. And I said, I'm going to do what I know best, and I'm going to lean on my advisors for the rest of the advice. And I've got to put a check in place to see whether I'm getting the right advice. But build an ecosystem and lean on them heavily. You cannot do it alone. Otherwise, you're going to falter and you're going to fall apart. To me, it is being a part of an ecosystem. Go in a pack, and I mean, great team is important. That's your pack. But great associates around you, advisors around you, is critical as you grow and exit a business.
Well, I thank you for your time, Altaf. I think you did a great job and gave some great advice. And I'm going to end it with pull together a great team, seeing we have a great team around here, sitting here. So, Peter?
Absolutely.
Terry and Altaf, thank you so much. I think everyone watching will agree that Altaf has achieved the graduate level of business ownership, and he didn't even read the book. So really impressive story and some great principles to go by. I'd like to thank Terry and Ronen and Tom and Altaf for making this event happen and sharing their wisdom. And special thanks to Central Mass Productions. There's Matt Majakis behind the cameras here for hosting us in their studio today. Thanks again. Great conversation. Hope you all had some great takeaways today.
Thank you.